All right, folks, welcome back. This is episode number 8, applying institutional order flow to Forex markets. All right, so we have the daily chart up for Euro Yen. Just so you know, I hate yen pairs. I can't stand them. But for the sake of completeness, this is how you would look for these types of patterns in Forex. All right, take a look at the relative equal lows over. You see that? It's going to go quick and dirty tonight. All right, so we have relative equal lows marked out over here. The market has traded down through and created a run higher. Now here is why I do not like the yen pairs. They tend to have like a double return to a specific level I like to see, and you're going to see it right here. Okay, swing high, the market rallies through that. There's no fair value gap there. It drops back down in, then it runs again, taking out this swing high. So we have 2 points of market structure that have moved to the upside. In other words, prices traded above it. Now this leg here, you want to go back through that and see, is there a fair value gap? Well, we have 1 and 2. The market trades down into it here, sends it higher. What's above here? Buy side liquidity. This old high back here could be a draw on liquidity as well. So there's going to be buy stops. Whether it trades there or not, it's irrelevant. Okay, it's likely to draw to it. Now, obviously, we started trading a new day here, but this candle, which was the 10th of February, 2022, this daily candle, we could trust that this was likely to go higher because we went up, we've consolidated, and then start another run into this high here. Again, whether it trades through it or not, it's irrelevant, okay? Because even a failure swing to get above old highs, if there's enough range from being right here at the open to reaching up to here, that's enough to take a stab at it and to see if you're going to get any kind of yield. So that's an example of it occurring on a daily chart. But I want to go into this very day right there, okay, the 10th. So we're going to drop down into a 15-minute time frame. All right, here's the 15-minute time frame, and we're going to mark up our chart. Midnight New York time. Market rallies in here. And then we go into the New York session right here. So we're going to go into this price structure and ferret out the run that occurred in here. So I'm going to put a rectangle in this area so that way we know what we're looking at relative to this 15-minute time frame. All right, we're going to drop down to a 5-minute chart. And if you take a look at 7 o'clock in the morning, 10 o'clock in the morning, that's your New York ICT kills in. Okay, that's the time of day that New York session trades form. All right, so here is the time of day that the forming of a New York setup forms. All right, so we have the market trading down, takes out a swing low, trades down below that, and then punches higher, right above the swing high. Inside this price leg right here, is there a fair value gap? We're going to break it down from the 5-minute down to the 1-minute chart. So from this low up to this high, right in there, that's what we're going to study on each new time frame. So we'll go down to a 3-minute. Okay, so in this price leg here, do we take out a swing low? Yes. We trade down below a swing low. Does it take out a swing high here? Yes, it does. So now we have a valid condition to see if there's a trade. Go back through this price leg. Is there a fair value gap? Right in here. And this one here. So remember I was teaching you, it could stab down there. Just be mindful of that. But try to get your entry in on that one there. And that's what we have here. It trades down to it there. Now, the question is going to be is how far will it trade to? Because we're not looking at anything over here like it's a middle of the range type idea. So for expansion type moves, practical lesson tonight, where if we don't have a range to trade inside of, how do we anticipate how far it can trade up or trade down? In this case, we're looking for a long. Where would our targets be? Because the old high is over here. Now, I'm sure if we went to a hard time frame, keep looking to the left, we'll find something. But a real easy way is to take your price leg over here. See this swing low right prior to this run up? Then we consolidated, dropped down, created a discount, and then created our retracement, rally, and start to run up into these highs. How can we know? Well, I like to take a fib and anchor it to a previous swing. Okay, so from this low to this high, after we leave this consolidation and start to trade higher, standard deviation, -1, 133.153, and high is 133.15 3. So right to the point that you'd be looking for, and then we've seen it recede from that. Okay, so obviously when I show an example like this, it makes me want to trade the yen. But I hate this pair. I can't stand. There's other markets that can scratch my itch for Forex, but this one is not one I like to trade. But I wanted to come out tonight and kind of give you a quick view of what you could do with these markets using the model. Okay, there is a approach that you can use with the London session. Okay, and London would be marking up your vertical lines relative to New York local time, 2 o'clock in the morning to 5 a.m. So you'd have your bracket. So your operating hours would be hunting the setup for New York between 7 o'clock in the morning and 10 o'clock local New York time. For London session trades, you would look for setups that would provide you a way to trade a fair value gap between 2 o'clock in the morning and 5 o'clock in the morning. So in summary, we can anticipate this market going higher. Why? Because the euro dollar is going higher. You can also check it by going to, let's go to a daily chart first. And you can go to 6E, which is Euro futures, and we'll just use the front month continuous. Okay, you can see how Euro, where's it been going? So has it been going lower or higher? Clearly going higher. What has the yen been doing? So when you look at Forex pairs, you want to look for that relationship between the instruments that make up your pair. So Euro yen, Euro is strong, yen is weak. So what would that mean for Euro yen? It would mean that if your bias is bullish and you have this underpinning between Euro and yen, it's going to make this pair go higher. And it's a real simple way of looking at how to determine these exotic crosses, okay, and how to frame the logic behind whether it should go higher or lower.